Good afternoon, ladies and gentlemen. May I request everyone to be seated? I know we are running late. Ashish has come from Bombay just for this, and he's going to be flying back. First of all, I'd like to check with the audience. I asked the ICC team, should we do this in English or Hindi? English or Hindi? Okay, all right. Just as the WTM mentioned that he's spent his childhood in Kolkata and studied here, I say this every time I come to Kolkata that I am also born now only 2 hours away from Kolkata. I am from a place called Asansol. I was born there, and Calcutta or Kolkata now is truly for me always a city of joy. I have always loved coming here. This time it's been a little longer, so maybe that's why many of you I haven't interacted with, but it's been great to meet a lot of old friends today already, and I look forward to meeting some more as the day proceeds. Since there is a paucity of time, this will be more like a rapid fire round because there's Ashish and then we have a very eminent debt market expert as well. Normally, I prefer to do the interviews in a more relaxed way, but I will be getting straight to the point. Ashish Somaya needs no introduction. He looks very young. He is young. But you'll be surprised at the amount of experience and knowledge that he carries about the mutual fund industry. He started when the private mutual fund industry really, took birth in India in a post-UTI world. So yes, while I look that, he doesn't. But a big hand for him, ladies and gentlemen, for him to have agreed to come and be part of this. First question, Ashish, we've seen a massive amount of FII selling. How concerned are you about that? Why has that happened?
So yeah, I think a lot of the conversation almost sounds like they'll pretty much sell to zero and the market will just crash. There's a lot of panic. At least whenever it is discussed in media or newspapers or even in, informal conversations, the impression one gets is that there is so much of selling that, it's something unprecedented, right? But actually it is overplayed if you really look at the numbers. First you look at the very long range numbers and then you look at last few years. If you look at, say, for example, the very long range, see a lot of the industry data, a lot of Sensex and Nifty data, people tend to start it from 1979. The reality is that our markets opened up in 91, 92. So you should look at all this FII data and all the frameworks from 92 onwards, right? In 1990, probably 91, 92, India's market cap was 2 lakh crores. When our market cap was 2 lakh crores, obviously FII holding was zero because foreigners were not allowed to invest, right? So at 2 lakh crore market cap, FII holding was zero. Today, we are well over 4 lakh crores market, 400 lakh crores. So 2 lakh crore FII holding is zero and 400 lakh crores FII holding is north of 17%. So if you actually see the long range history, and by the way, in India, 50% of the market is owned by promoters and the government as a promoter. So this 17% is actually 17% out of the other 50, which is obviously 30% plus, right? Second important thing is that our problem is not that FIs are selling. Our problem is that they already own a significant part of the market. Now coming to the near term, if you see right from 2010 onwards, what you will find is that almost every year there is a high double-digit billion dollar of buying in India, ranging from let's say for example post Lehman, if you look at 2009, 2010. In a span of about 18, 19 months, we got $40 billion in 2009-10, right? After that, barring 2 years, barring 2 years, practically every year, there is buying ranging from 5 billion net positive right up to 22 billion net positive. So there has never been a concerted period when it is negative. Coming to this year, even this year, from January to 30th September, it was net positive. And only October and November, it has turned negative. So I think somewhere mid-November when I checked, for the full year we were -2 or -3 billion. Now it must be 4 5 billion or something, right? So I think too much is made out of it. In reality, in most years they have been significant buyers. In the long range, they've cornered 17% out of the 50% which you can call free float, right? And in many companies, in fact, there is a very, very high FI holding. So I think it's blown out of proportion. In fact, if you compare, like right now I said that this year there is an outflow. Tiniest of markets like Vietnam and Brazil and Philippines, even they are net negative. And some of them are worse net negative flow than even India. So if you compare us with other emerging markets, you'll actually conclude that India has been a darling of the FIIs, right? And I think there is absolutely nothing in the data to say that they are deserting us. It's as simple as this. If you have to send money to US and you find that the rupee is appreciating, you will postpone sending it by a few days. And if your brother or somebody sending money to you from US to India, if he sees the rupee falling, he'll say, okay, 7 दिन बाद भेजेंगे, right? So I think a lot of it is emerging market turbulence. A lot of it is currency, a lot of it is dollar appreciation, US interest rates. I think these are a variety of short-term phenomena. But if you see long range, there is nothing in the data to say that FIs are not investing in India.
The Q2 earnings that we saw recently were disappointing, and then we saw just yesterday the GDP number that came, where even senior government officials, including the CA, what I read in the papers, said disappointed with it. Is that a blip, according to you, at least as far as the corporate earnings are concerned? Because that's the part that your fund managers would be looking at. Is that a blip, according to you, or do you see that suddenly the numbers that were looking so great may continue to be lukewarm going forward in this financial year?
So, I think there's no doubt that market performance will always chase earnings growth. So to that extent, it would be an understatement to say that numbers are great or something. I mean, yes, the numbers have started to taper off. Because if you see the long range, in India, you have to see the earnings growth clearly in 3 phases. If you see 2002 to 2008, we had stellar earnings growth, more like 24-25% compounded. If you take 2009 to 2020, it was pretty much a disaster because for the entire 12-13 year period, the Nifty earning growth was barely 3 to 4% compounded, right? And that's the time when people used to say, "Nahin, Asian Paints, Bajaj Finance, HDFC, nothing else will work," etc. And then now after 2020, you've seen like a double-digit 20% plus earnings growth. Now clearly in the last quarter, you have seen a slowing trend. But I would put it this way, the numbers are not looking good and they are slowing down is a fact. But there is a couple of points of nuance to this. One nuance you should keep in mind is that we announced, I think elections were announced in March, and through April and May we had elections. Then the government formation and then the budget came in July. And I read recently that for the full year, the government's deficit should be 15-16 lakh crores. I mean, revenue minus expense. For the full year, if the deficit should be 15-16 lakh crores, in the first 6 months, the deficit was barely 28% of the targeted deficit. If you actually think of the deficit, the way it should move is that in the first 6 months, you should be achieving 60-70% of your deficit target. And then in the second half, the revenue picks up, and then the deficit tapers off, and then you end up somewhere near your target. But this year, the way it has worked out is that in the first 6 months, the deficit is only 30% of what it should be, which means that the government is collecting revenue but probably not spending. And it's not spending because obviously the government for the first 3 to 4 months is either busy or being formed or, not in the saddle fully. Second important, so that obviously flows through the economy because the government has been the biggest spender when it comes to capex and projects and many other things. The second thing to keep in mind when it comes to earnings is also that if you remove commodity, metal and oil, the earnings is actually not that bad. I mean, it's not 20% year on year, but it is about 11-12%. So if you take Nifty aggregate earnings, it looks like there is a degrowth. But then you strip off oil, metal, commodities, you will find that there is a positive 10-11% growth. Now, of course, if your portfolio is laden of commodities, you're not happy with that. But if your portfolio is such that oil, metal, commodities are input to your portfolio companies or portfolio constituents, then you're not that unhappy about it, right? Because I think if oil, metal, commodity is going to drive the earning growth, it will show up in the numbers, but qualitatively not that good. So if you see last quarter earnings growth is not that great, it's true, but I think good amount of degrowth is because of oil, metal, commodity prices, right? So there is some amount of nuance, and I think what the number is printed now is behind us. Now you have to see, like for example, how well the government did on spending. October numbers will probably come now, right? So we have to see how things are changing, how the deficit number is flowing, and how government spending is evolving. The jury is still out on it, but I would guess the worst is behind us. That's what I would think.
You know, while retail investors would be, as you also said, that, you know, there's a panic because we hit 85,000 and now we are struggling at 80,000, lots of volatility in the last 15 odd days. But do you believe that smart investors, and that's the kind of people in this audience, still find the levels expensive and would like to probably invest when they kind of come down a little bit more?
So, you know, there is a phrase, when I was a kid, I used to hear this phrase very often on Doordarshan. And yesterday I wrote it also because somebody was asking me, how do you think the market is holding up? So I was telling them, Sthiti tanav purna parantu niyantran mein hai. You know, you hear that a lot of times on TV in the past. Nowadays, they don't speak that kind of Hindi anymore. But I would say that, you know, market is in an awkward kind of balance. It's not like people are panicking, but it's definitely, I mean, you know, at a point in time, we were 12-13% down from the peak, which is good for the, I mean, corrections are always good. So a few days back, we were almost 13%. Nifty was 13% down. If you look at a lot of sectors and stocks, like the darlings, like defense and PSU and all, probably 25-30% down from the 52-week high. But what I've seen is that neither people are jumping in saying that, okay, these are attractive levels, nor am I seeing that people are really scared or really panicking. The other thing what I would like to highlight is that a lot of people who are forming their impression that market has gone up a lot, somewhere I feel they are basing their assumption or they are basing their calculation in the bottom of COVID. See, it's like this, you know, when I was in college, I read this book. You know, anybody who studied statistics in college has studied it from this book called Levin Rubin. Okay, I have not read the whole book, but I've read the preface. The preface of that book, it's a book on statistics. It says statistics for management. The preface of the book says there are 3 types of people in this world. There are liars, there are damned liars, and there are statisticians. Okay. So,
is that why you didn't read the full book?
Yeah, that's why, I mean, I didn't read the full book because I never went to college. I mean, I was already working. But why did I quote that? I'll tell you the reason. Because, you know, I'm not trying to prove anything in either way. That's why I put that as a disclaimer. But look at it this way. अगर आपको कोई बोलेगा कि भाई पिछले 4.5 साल में इंडेक्स 3 गुना चल गया, तो सही है. Because मार्च 2020 में 8700 था, अब थोड़े दिन पहले 26,000 था. तो 4.5 साल में 3x. It is crazy. There's no debate or doubt about it, right? But look at it this way, that when Nifty went to 8,700 or Sensex went to 25,000, what were we pricing? We were pricing case fatality rate of COVID will be 5%, vaccine will take 10 years. RBI announced a moratorium because most banks would go under. You and me will be locked up at home for 2 years. You know, these were the thoughts when we went to 8,700. So the bottom of the market was pricing the worst case scenario, but did any of the worst case play out? So you need to step back and you need to see that, okay, 6 months before COVID, Nifty was about 11 to 12,000, Sensex was 40,000. 6 months after that COVID fiasco, say by October, November, Nifty was back to 12,000, Sensex was back to 40,000. If you look at Sensex EPS, in September 2020, 1,500, in September 2019, 1,500, in September 2020, 1,600. तो अगर आपको कोई ब्लैंक आउट कर देगा तो आपको पता चलेगा कि कुछ हुआ ही नहीं है बीच में. So if you look at 5-year return of Sensex and Nifty is 15% compounded. If you look at 4 years, it is 18% compounded. I don't think anybody here has seen a bubble where the Nifty return is 15% compounded for 5 years. And in those 5 years, Nifty and Sensex earnings has also compounded at the same rate. Correct? So, क्या है कि आप ढूंढने निकलोगे तो मार्केट का कोई ना कोई पार्ट में बबल होगा ही होगा और ढूंढने निकलोगे तो मार्केट का कोई ना कोई पार्ट सस्ता होगा ही होगा. बट टू जनरलाइज द होल मार्केट सेइंग इट्स गॉन अप अ लॉट, आई फील एनीबडी हु सेज द मार्केट इज गॉन अप अ लॉट, मेरा तो दो ही कंक्लूजन है. या तो कोविड के बॉटम से देख रहा है, या तो सोचा था उससे कहीं ज़्यादा रिटर्न बन गया है. तो बट आई थिंक market is fair. I mean, it's for stock pickers. It's not on either side exaggerated.
One final question, Ashish. What are your preferred sectors? What are your fund managers right now focusing on? Because again, when you invest keeping in mind the future performance of those sectors. So 2 or 3 sectors that you like at this point of time where there's a lot of good movement still awaiting us.
Yeah, so see, because it's a mutual fund summit, and there is, I would say, mutual fund evangelists and mutual fund investors who are in the audience. So I just want to share one piece of statistic. See, if you take BSE 500 breakup, and I'll come to the sectors because the message is hidden in what I'm saying. If you take BSE 500 and you take a split of BSE 500 and say the top 100 which is large cap, next 150 which is mid cap, and then the 250 which is small cap. So you take the market cap of BSE 500 and you break it that what proportion of BSE 500 market cap should be large cap, what proportion is mid cap, what proportion is small cap. आप पिछले 10-15 साल का हिस्ट्री लेंगे ना, तो आपको मिलेगा कि भाई at the highest point large cap has been 77% as a proportion of BSE 500. Today large cap is 61% as a proportion of BSE 500. If you take the history, the average is that large cap is 70% of BSE 500 and small cap, mid cap as a proportion is 30%. Today it is 40%. Average is 30%. Least is 20%. Now, this is the lay of the land. That भाई BSE 500 का क्या composition है. तो अगर आप सोचते हैं कि भाई कोई अगर neutral weight investor है, aggressive भी नहीं है, defensive भी नहीं है, जैसा market है वैसा पैसा लगाना चाहता है, तो आप जाहिर सी बात है कि उसके portfolio में 65-70% large cap होना चाहिए for a neutral weight guy. Aggressive guy can be 50% small and mid cap, and a defensive guy may be fully large cap. So, but you will keep the averages in mind. Do you know that in the last 12 months, Indian investors have put roughly 3.5 lakh crore rupiah net, inflow minus outflow, 3.5 lakh crore rupiah net has gone into equity mutual funds. I'm not even talking balance advantage and all. Pure equity, no index fund, no ETF, just equity mutual funds actively managed. 3.5 lakh crore गया है. अब जो मैंने आपको market cap का split बताया, based on that, आपका क्या guess है? How much of that should be in large cap funds? अगर 3.5 लाख करोड़ रुपया म्यूचुअल फंड में लगा है, एंड औसतन अगर म्यूचुअल फंड्स का जो BSE 500 स्प्लिट है उसमें ऑन एन एवरेज अगर लार्ज कैप 65-70% है, तो जो 3.5 लाख करोड़ लगाया गया है उसमें से कितना पैसा लार्ज कैप में जाना चाहिए था? एनीबडी हैज अ गेस? It's 4%. What is actually deployed in large cap is 4%. If you argue that भाई large and mid cap का आधा large cap होता है, flexi cap का 60% होता है, वो सब कुल मिला लो, what you will find is that 18 to 19% of the money has gone into large cap. Bulk of the money has gone into small cap, mid cap, and 40% of the money has gone into thematic funds. And those thematic funds are not banking, IT, pharma or consumer. Banking, IT, pharma, consumer is also 60% of the market. But where has the money gone? Defense, infrastructure, energy, commodities, PSUs. So what is happening is that people's portfolios are way out of the playground. So today people need to rebalance and bring the portfolio back in the center. You need to move back to large cap. You need to move back to banking, pharma, IT, consumer. You know, Calcutta people love soccer. 90-minute soccer game, tell me, out of 90 minutes, 75 minutes, where is the soccer ball in the playfield? I'm not talking Argentina versus Nepal. I'm talking Brazil versus Argentina match. If it's a 90-minute soccer match, for 75 to 80 minutes, where are you likely to find the ball in the playfield?
In the middle.
In the middle. That's why they track ball possession. China japti hai. Have you ever seen a soccer match where for 75 out of 90 minutes, the ball is in somebody's penalty area? वो 75 minutes ball penalty area में रखेगा तो सामने वाला आपको गोल मार के जाएगा. Right now, most people's portfolios are somewhere in the penalty area of the market. It needs to come back in the center. That's the key thing to keep in mind.
Kolkata people also love cricket. What's your cricket analogy? Okay.
Test match, खेलो, test match. Play test matches.
We are very near Eden Gardens, by the way.
Yeah, play test matches.
Yeah, okay. Play a test match. All right. Thank you.
Thank you.
Very much, Ashish. I know it's been a short conversation, but very, very rich as always. Thank you.